China just made a move in the silver market that almost nobody noticed. While everyone was watching Bitcoin hit new records and gold hover near all-time highs, the People's Bank of China quietly adjusted its strategic reserve ratios in November. Buried in the third paragraph of a Shanghai Metals Market report dated December 14th was a single line. Industrial silver allocations for photovoltaic manufacturers increased by 18% quarter over quarter. That might sound boring. It's not. Because when you combine that with what's happening in New York, London, and the physical delivery markets, you start to see a pattern that looks disturbingly similar to two moments in history when silver didn't just go up, it went parabolic. And both times, the people who recognized the pattern early made generational wealth. The people who didn't spend years wishing they had. Let me be very clear before we go any further, this is educational content only. I'm not a financial advisor, and nothing I say here constitutes financial advice. Do your own research and consult with a licensed professional before making any investment decisions. What I'm going to walk you through today is a framework for understanding what appears to be happening in silver markets right now, why it matters, and what history suggests could happen next. Let's get into it. Here's what most people miss when they look at silver prices. They see a number on a screen, $63, $65, whatever it happens to be today, and they think that's the whole story. It's not. That number represents the paper market, the futures contracts traded in New York on the COMEX exchange. But there's another market, the physical market, where actual metal changes hands. And right now, those two markets are starting to dislocate. When that happens, when the paper price and the physical reality start pulling apart like tectonic plates before an earthquake, that's when things get interesting. And by interesting, I mean violent. Now, let me take you back to 2011 for a minute. Silver had been climbing steadily from around $17 in mid-2010. By April of 2011, it hit $50 an ounce. In less than a year, it nearly tripled. Then it crashed, falling back to $26 by the end of September. A lot of people lost money on that spike. But here's what they don't tell you. The conditions that drove that spike were fundamentally different from what we're seeing now. In 2011, it was mostly speculative. Hedge funds piled into silver futures after the financial crisis, betting on inflation that never really materialized. When the Federal Reserve didn't go full Weimar Germany with money printing, those funds unwound their positions and the price collapsed. The physical market was tight, sure, but it wasn't broken. Dealers could still get product. Refiners were still taking material. Premiums were high, but not insane. Now look at today. According to data published by the Silver Institute on December 10th, global silver mine production declined by 2% in 2024. Meanwhile, industrial demand, this is silver used in solar panels, electric vehicles, electronics, medical equipment, increased by 7%. You don't need a PhD in economics to understand what happens when supply goes down and demand goes up. But here's the kicker. That's just the visible demand. What we're seeing now with China's reserve adjustments, with central banks in Asia and the Middle East quietly adding silver to their holdings alongside gold, is a whole other layer of demand that didn't exist in 2011. The Bank for International Settlements reported in their quarterly review from December 12th that central bank metal allocations, gold and silver combined, hit a 30-year high in the third quarter of this year. They don't break out silver specifically in that report, but commodities analysts at Bloomberg noted on December 15th that silver ETF inflows surged to levels not seen since the COVID panic of 2020. So we have declining mine supply. We have industrial demand that's only going to accelerate as countries push for renewable energy and electric vehicles. We have central banks diversifying away from dollar-heavy reserves, and we have speculative interest returning to the market. That's the setup. But there's one more piece to this puzzle that almost nobody is talking about: Basel III compliance. If you're not familiar, Basel III is a set of international banking regulations that went fully into effect in June of 2021 for European banks and January of 2023 for U.S. banks. One of the key changes is how precious metals are classified on bank balance sheets. Physical allocated gold and silver, metal you actually own and have title to, is now considered a Tier 1 asset, meaning it's treated the same as cash for regulatory purposes. Unallocated metal, which is basically a paper promise that the bank will deliver metal someday, is considered a liability. This is a big deal because it means banks that were running fractional reserve schemes in precious metals, where they sold the same ounce of silver to multiple customers on paper, now have to either hold a lot more physical metal or get out of the business entirely. Several major bullion banks have already reduced their exposure to precious metals trading. That reduces liquidity in the market. And when you reduce liquidity in a market where physical demand is spiking, you get price dislocations. J.P. Morgan's Commodities Desk published a research note on December 13th suggesting that silver could test $75 by the end of the first quarter of 2025 if current delivery pressures persist. They specifically cited tightness in the COMEX warehouse system, where eligible silver, that's metal available for delivery against futures contracts, has dropped to levels not seen since early 2020. When eligible inventories drop, it forces short sellers who are betting against silver to either deliver physical metal they might not have or buy back their contracts at whatever price the market demands. That's called a short squeeze, and short squeezes in thinly traded markets with heavy leverage can get ugly fast. Now let's talk about what's happening on the ground at actual dealers. Reports from coin shop owners across the United States over the past 3 weeks indicate that premiums on government-issued silver coins like American Eagles, which normally trade at $2 to $4 over the spot price, spiked as high as $8 over spot in some markets before settling back to around $5 over. More telling, premiums on numismatic silver, coins that used to carry collector value above and beyond their silver content, have collapsed. America the Beautiful 5-ounce coins, which were minting at $30 to $40 premiums when they were first released, are now selling at spot price in some shops. Why? Because when the underlying metal value shoots up fast enough, it overwhelms the numismatic premium. That's exactly what happened to $20 gold pieces and other pre-1933 gold coins earlier this year when gold crossed $2,500. The gold content became more valuable than the collector premium. That tells you something important. This move in silver is being driven by the metal itself, not by collector demand or numismatic speculation. People want ounces. They don't care if it's a commemorative coin or a generic round. That's a sign of real demand, not speculative froth. On the supply side, refiners are rationing how much silver they'll buy back from dealers. Normally, a coin shop can sell as much scrap sterling silver or used bullion back to a refiner as they want. Not anymore. Multiple refiners have put weekly limits on dealer accounts. Why would a refiner, whose entire business model is based on buying metal and processing it, turn away supply? Because they can't process it fast enough, or they're worried about liquidity, or they're getting squeezed themselves by the same dynamics that are hitting the banks. Whatever the reason, when refiners start rationing purchases, that's a red flag that the physical supply chain is under stress. Here's where it gets critical. If you look at the inflation-adjusted all-time high for silver set back in 1980 when the Hunt brothers tried to corner the market, it's around $145 per ounce in today's money. Silver is currently trading at about $63. That means even if silver went to $100, which is the number a lot of analysts are throwing around for the first quarter of next year, it would still be less than 70% of its real all-time high. Gold, by contrast, just hit its inflation-adjusted all-time high earlier this year at around $4,000. So silver has a lot of room to run just to catch up to where it's been before in real terms. But here's the question nobody wants to ask. What if it doesn't hit $100? What if this rally stalls out at 70 or 75 and then pulls back like it did in 2011? That's the scenario you have to game out if you're thinking about this seriously. The bearish case goes something like this. Speculative money has piled into silver futures expecting a moonshot. If the price stalls and starts chopping sideways, those speculators will get bored or scared and they'll unwind their positions. That selling pressure could overwhelm physical demand and push the price back down. Additionally, if industrial demand softens, say if there's a recession and solar panel installations drop off or if electric vehicle sales slow down, that removes one of the key pillars supporting this rally. And finally, if central banks decide they'd rather hold gold than silver for reserve purposes, that removes another source of demand. Those are real risks. The difference between now and 2011, though, is that the structural factors supporting silver are much stronger this time. In 2011, industrial demand was growing, but it wasn't critical. Today, silver is mission critical for the energy transition. You can't build solar panels without it. You can't build EVs without it. And unlike 2011, when central banks were actively selling gold and ignoring silver, today they're buying both. That doesn't mean the price can't pull back. It just means the pullback is less likely to be as severe or as long-lasting as it was back then. So where do we go from here? There are 3 scenarios worth watching. Scenario 1, the squeeze intensifies. COMEX inventories continue to drain. Industrial users start panicking about securing supply and the price breaks through 70, then 80, then starts making a run at triple digits by March. In that scenario, you'd expect to see premiums on physical silver spike even higher, delivery delays stretch out to months instead of weeks, and a flood of mainstream media attention that brings in a wave of retail buyers who missed the rally so far. That's the bullish case. Scenario 2, the market consolidates. The price chops around between 60 and 70 for the next few months, while the physical market catches up with demand. Refiners work through their backlogs, mines increase production slightly, and the speculative froth settles down. In that scenario, you'd see premiums come back down to more normal levels, delivery times improve, and the market enters a more stable uptrend. That's the neutral case. Scenario 3, the rally breaks. Something changes, maybe the Fed pivots back to rate hikes, maybe a recession kills industrial demand, maybe a major bullion bank dumps a huge position to meet a margin call. And the speculative longs panic. The price drops back to 50, then 45, and we go into another multi-year consolidation phase. That's the bearish case. Which one is most likely? Based on the data we have right now, I think Scenario 1 or Scenario 2 are far more probable than Scenario 3. The physical supply situation is just too tight, and the structural demand factors are too strong for this to be another 2011-style flash crash. But that's not a guarantee. Markets can stay irrational longer than you can stay solvent, as the saying goes. If you're trying to figure out how to position yourself, here's a framework. First, understand what you're buying and why. If you're buying silver as a hedge against currency debasement and economic instability, then short-term price swings shouldn't matter to you. You're holding for the long term. If you're buying silver because you think it's going to $100 in 3 months and you want to flip it for a quick profit, then you need to be watching those COMEX inventory numbers, those premium levels, and those industrial demand reports like a hawk, because any one of those could signal that the rally is running out of steam. Second, diversify within your silver holdings. Don't put everything into one form. Government coins like American Eagles have liquidity and recognizability, but they carry higher premiums. Generic rounds and bars are cheaper per ounce, but might be harder to sell in a panic. 90% constitutional silver, old U.S. dimes, quarters, and half dollars are trading near spot right now, and they're highly liquid in a crisis because everyone recognizes them. A balanced mix gives you options. Third, keep some dry powder. If this rally does stall out and pull back, you want to have cash available to buy more at lower prices. If it doesn't pull back and just keeps ripping higher, you'll still participate with what you've already bought. Either way, you're positioned. And fourth, do your own research. Read the reports from the Silver Institute, the COMEX inventory data, the commentary from analysts at the major banks. Check multiple sources. Don't just take my word for it or anyone else's. This is your money, and these are your decisions. Silver's move from 53 to 63 in 3 weeks is historic. If it goes to 70 to 80 to 100, it'll be the story of the year. But even if it doesn't, even if this is as high as it goes for now, the underlying dynamics in the silver market have changed in a way that makes this metal more important and potentially more valuable than it's been in decades. China's reserve adjustments, the Basel III regulations, the renewable energy demand, the supply constraints, all of that is real. The question isn't whether silver is going higher long term. The question is how fast, how far, and how volatile the ride is going to be. Keep your eyes on the data, keep your emotions in check, and whatever you do, don't bet more than you can afford to lose. Because in markets like this, the only certainty is uncertainty. But if history is any guide, the people who recognize the pattern early, who do the work, who stay disciplined, they're the ones who look back 5 years from now and realize they were standing at the beginning of something big. Stay sharp out there.